the importance of using the exchange to buy or sell your crypto, and when you buy or sell it, to withdraw it and keep it in your own custody. That is referring to the best practice for how to invest and how to control your money. But as a trader, the intention and the purpose of trading is to enter and exit positions more frequently, holding them for shorter periods of time and trying to capture some profit from the market. So to do that, you're going to leave money on an exchange and you're going to have to use various orders that we're going to talk about in future lessons. But there are two predominant ways that you can trade, and you'll hear these frequently mentioned inside the real world and online, so I'll cover them now. The two ways that you can get exposure, buying, selling an asset, are through spot or perpetual futures, also known as perps. Keep it very simple. If you buy spot Bitcoin, let's say, you exchange fiat currency for that Bitcoin. So you give dollars, you get an actual Bitcoin, which you then own. On the other hand, perpetual futures, instead of getting the actual Bitcoin, you enter into a contract with another trader and you say, I want to buy Bitcoin. He says, I want to sell Bitcoin. And the derivative contract, which is the perpetual future, allows you to speculate on the price without actually owning it. The reason perpetual futures exist, there's many reasons. One of the main ones being that they offer margin, or leverage, as you may know it, which means that you can use a fraction of the price of a Bitcoin, let's say, to open a position and trade it. They also offer flexibility. There are only so many coins. There are only a finite number of Bitcoin, 21 million. But by having perpetual futures, it creates a much larger market because there are billions and billions and billions of dollars of contracts being traded on Bitcoin. So it creates more liquidity, which allows more people to trade, which allows more investment to come in, which allows more activity, and then feeds a bigger market. So they are necessary, they are very useful, and used correctly, they are a great tool for trading. Inside the crypto trading campus, you can arrange the sidebar on the left to your liking. You can collapse each of the individual sections to make it cleaner. You can expand whichever ones you want. So if you want to have a focus on analysis and the chats, you can do that. A lot of students find this makes things easier to navigate, allows them to focus better, and it's fully customizable to your preference. So check that out and use it wisely. I use solely perpetual futures for trading. So the purpose of this lesson is to give you just a basic breakdown of what they are, because I'm going to talk about them a lot, and it's all that is used throughout the rest of the lessons. So familiarize yourself with that. My advice is, if you just want to buy crypto and hold it for an extended period, maybe you're following Adam's signals, maybe you're just buying crypto for yourself, then use a spot market and put it into your own custody. If you want to trade crypto shorter term, you want to make multiple entries, you want to not necessarily own it, you want to speculate on the price of it over the short term or the mid-term, then use perpetual futures. In the previous lesson, I talked about the difference between spot markets and perpetual futures markets. I also told you that I myself trade on perpetual futures markets. The reason being liquidity plus the ability to easily go long and short, as in buying and selling the asset. While you can do those things on spot, it is much more difficult. And I recommend that if you're going to learn how to trade and you're going to trade in crypto, that you need to have access to perpetual futures markets. That will be okay for pretty much everybody except people in the US, where it is a little bit more difficult. So I do not recommend any specific exchange. I tell you that I trade myself on Bybit and have traded on Binance as well. But I do not recommend any specific exchange. Whatever exchange you use is totally up to you, and you take full risk and responsibility for that. I say, and I'll reiterate, keep as little money on the exchange as possible, only the bare minimum that you need to trade with. That being said, here are some popular and well-known exchanges, all of which offer futures trading, which is necessary to access perpetual futures and then be able to trade in the way that I teach. Binance, Bybit, BitMEX, OKX, and KuCoin, they are all centralized exchanges, meaning that when you give your money over to them, it is no longer your money. It is in their hands until such times as you withdraw it. So be mindful of that. At the bottom, I've added in another exchange called GMX, which is decentralized, meaning that you connect a wallet to it, a wallet that you would hold tokens in, a self-custody wallet, and you can trade on that. In that particular exchange, your money is not at risk, at least not from somebody stealing it or exchange malfunction. Your money is still within your custody. So you can look into that if that is the type of thing that you want. And also from the list of these exchanges, I do not live where you live. So please do not ask me, what do I do if I live in X country? I don't know if you're in Brazil or you're in Canada or you're in the US. I don't know your laws. I don't know the local rules. What I would suggest is go through each of them and find one that does work. There are many, many, many students here from every country that I can think of, and they are all able to trade. So there is a solution for you if you do a little bit of research and you find it. That being said, let's move then to the order types. Inside the crypto trading campus, you will find a section of analysis. We've got 4 channels in there. Trading analysis is where you can see my latest thoughts on the market, updated every day. Just charts is where I highlight specific coins and track them over time from high time frame to low, giving ideas of potential trades and what I'm thinking about. Daily levels is where every weekday I post a video looking at the day ahead, trade ideas, levels, and some setups for plays. And the week, month outlook is where once a week there's a weekly preview video, and once a month there's a monthly preview video looking ahead to all the action in crypto. So check. I class them, and then there are things called conditions. This is when you're on the exchange and you're trading, when you open up the interface to actually buy, sell, put in a stop loss, take profit, your winning trades. You have to use orders. So the standard orders are the ones that you should stick with as much as possible. They are a market order, limit order, a stop market order, a take profit order, and a trailing stop. You can see the descriptions from there. There's also a sheet along with the lesson with the full descriptions. I do not need to explain them. The most important ones are market order and limit order. They are what makes the market up. There are two types of trader in the market. There is a maker and a taker for every position. So if you think about it, you understand that there has to be a buyer for every seller. So for somebody to buy or sell, they need to execute an order. If you want to buy right now, you use a market order. If you want to get an immediate fill, you use a market order. If you don't mind getting filled later and you want to get a better price, maybe for a buy order you want to buy lower, or for a sell order you want to sell higher, then you use a limit order, which is an order to buy or sell at a specific price at a later date. They're the main two. That's the only two ways that you can enter a trade, is either with a market order or a variation of that, or with a limit order or a variation of that. They're the fundamentals. Also at this point, I'll go into this in more depth after, but buy, sell, long, short are the same thing for the purposes of these lessons and for how we speak. Buying and longing is the same thing. You buy a coin or you go long. You sell a coin or you go short. You will see those used interchangeably on your exchange interface. So just understand that they mean the same thing in that sense. A stop order is what you will know, if you have any experience with crypto, you will know it as a stop loss. That does exactly as it says. It stops your losing trade at a defined point, so you lose only a fixed amount of money that you decide. So the important thing here is to use, and always use, I recommend, a stop market order. We'll get on to what a stop limit order is in a sec, but just make sure you're using a stop market order so that when your trade loses, it actually executes and gets you out of the trade. You don't want to get caught in a big move on the wrong side. A take profit order is an order you set at the start when you enter that just presets an area for you to take profit if you win. And a trailing stop order is an order that follows price, so that let's say you're in a winning trade and it keeps going up, you don't know when to take profit, so you set a trailing stop below it so that if it drops back a certain amount, it exits the trade and you take profit. It's a way of locking in profit. Advanced orders. Note that word. If you're brand new to trading, you shouldn't even look or consider any of these. Even now, I rarely ever use any of these orders. They're just here for the sake of clarity. Stop limit order is the same as a stop market order, as in it's an order you would use to exit a trade, typically. However, it can only be executed as a limit order, meaning that when it reaches the level that you want to exit, it will not execute and take you out of the trade. It will put a limit order at a level you set, meaning the price has to then go through that limit order. In a very simple sense, you should just avoid it because there is a risk with a stop limit order. Let's imagine you're long and there's a big crash like there can be in crypto. And instead of stopping you out at your defined level with a stop market, you use a stop limit. Well, that price might go right through your stop limit order and further down and completely liquidate you, because a stop limit order is not guaranteed to execute. The other three I won't talk about: immediate or cancel, fill or kill, good to cancel. They're self-explanatory. You can see that there. The last two are important. Conditions. These are not orders. These are conditions that you add on to your order. Reduce only. This is important. Anytime you can see this, that when you're in a trade, always use this if possible. What this means is if you're in a long or you're in a short and you have a stop loss or you have a profit level, if you use reduce only, it will ensure that your position that's open is the only thing that can be edited. It can only be reduced. It will not allow you, let's imagine you're in a short and you're short 1 Bitcoin and you put a stop loss, and instead of doing it for 1 Bitcoin, you accidentally do it for 2 Bitcoin on your stop loss. Well, by using a reduce only order, it will only execute 1 Bitcoin when it gets hit, because it can only reduce your current size. It cannot open a position in the opposite direction. Very important. Best practice is to always use this for stop losses. Finally, post only. This is a box you check which ensures that your limit order will only execute as a maker order by adding liquidity to the order book. That's simply a way of reducing fees. It's not very important, and I will consider that more advanced. So if this is confusing to you, just ignore it. It's not that important. When navigating the crypto trading campus, you'll find a section called Prof. Michael. There's 2 channels in there, Michael's Journal and Ask Michael. Inside Michael's Journal, you'll find a collection of my daily thoughts, my habits, my routines, what I'm up to on a day-to-day basis, and my general opinion on some things maybe outside of crypto. In Ask Michael, you can come at any time and ask me a question, be it about trading, about crypto, about life, and I will give you a response in there. So check both of those out. and I look forward to receiving some questions from you. Final thing I'll say, out of all of this, you might wonder, why do these all exist? Why are there market orders, limit orders? Why is there maker? Why is there taker? It comes down to fees. A market order is much more expensive than a limit order. When you place your first few trades, if you've never traded before, go and look on your exchange balance, on your trade history, and you will see the difference in price between a market order and limit order. Exchanges charge fees, and they charge higher fees on market orders than they do on limit orders. That's what this all basically comes down. So that's it. That's everything you need to know to get started. So you can open an exchange account, play around with it. A lot of them have a test net mode, which is very good, meaning you can use the platform, buy and sell, long and short, without using real money. So you can get used to the user interface. Very, very much recommend that. I know Bybit has it. I'm not sure about the others, but you can check. Just check for Binance testnet, BitMEX testnet. Just Google those terms, you might find them. So now you know all the different order types, what they do, and how they work. Go through to the very next lesson, and I'll show you practically the fastest way to actually learn this, so that it's not just on paper and in theory, but that you're actually doing it in practice. Click through now and go through that lesson immediately.